Hi, this is Margaret from Estawise. In this video, we're going to walk through how the Canadian income tax system really works, without tax jargon and without overwhelm. Whether you're an employee, self-employed, or running a small business, understanding the basics can make taxes feel a lot less stressful and much more predictable. What the tax system does. At its core, Canada's tax system is built around one simple idea: ability to pay. Those who earn more generally contribute more, and those taxes help fund public services like healthcare, education, and infrastructure that benefit everyone. The system is also designed to encourage work, business, and investment. Why location matters. Where you live matters more than many people realize. Each province has its own tax rates, which sit on top of federal tax. That means two people earning the same income can pay very different amounts depending on the province they live in. Understanding this helps explain why your tax bill might look different from someone else's, even with similar income. One of the biggest misunderstandings about tax is how brackets work. Canada uses a progressive tax system. That means your income is taxed in layers. The first portion of your income is taxed at the lowest rate. The next portion is taxed at a higher rate, and so on. Only the income that falls into a higher bracket is taxed at that higher rate. Your entire income is never taxed at the top rate, so earning more money never reduces your take-home pay. You always keep more, even if part of that extra income is taxed at a higher rate. These are the federal tax brackets that apply across Canada. You don't need to memorize the numbers. What matters is understanding how income moves through these brackets gradually. As your income increases, it doesn't suddenly jump into a new tax rate all at once. Only the portion above each threshold is taxed at the higher rate. This is why taxes are more predictable than they feel. Once you understand the structure. There are two tax rates that are especially important to understand. Your marginal tax rate is the rate applied to the next dollar you earn. This matters when you're deciding whether extra income, overtime, or a side project is worth it. Your average tax rate is your total tax divided by your total income. This shows how much of your income you actually paid in tax overall. Most people focus on the marginal rate and panic, but your average rate is usually much lower. Understanding the difference helps you make calmer, more informed financial decisions. Not all income is taxed the same way, even if the dollar amount is identical. Employment income usually has tax, CPP, and EI deducted before you ever see the money. Self-employment income has no automatic withholding, but it allows business deductions. That flexibility is helpful, but it also means planning is more important. Investment and rental income follow different rules again, with their own tax treatment. Investment income can include interest, dividends, and capital gains. Interest income is taxed at your full marginal tax rate. Dividends from Canadian corporations receive a dividend tax credit, which can lower the overall tax you pay. Capital gains are taxed more favorably. Only a half of the gain is included in taxable income. Rental income is treated as passive income, but it's still fully taxable. You can deduct reasonable expenses related to earning rental income, such as mortgage interest, property taxes, insurance, and repairs. Understanding how each type of income is taxed helps you make better tax planning and financial decisions. For example, it can influence when you choose to sell an investment, when to recognize income, or how you structure your cash flow. Once you understand these differences, tax planning becomes less about reacting and more about timing and intention. Many people are surprised by their tax results, even when nothing went wrong. This usually happens for a few reasons. Having multiple income sources can push part of your income into higher tax brackets. Income without tax withheld, like self-employment or investment income, can lead to a tax balance owing. And misunderstanding marginal tax rates can make the final bill feel larger than expected. Deductions and credits both reduce your tax bill, but they work in very different ways. Deductions reduce your taxable income. That means they lower the amount of income that tax is calculated on. For example, business expenses, RRSP contributions, and some employment expenses are deductions. The value of a deduction depends on your marginal tax rate. If your tax rate is higher, the deduction is worth more. Tax credits, on the other hand, reduce your actual tax payable. They apply after tax is calculated. Credits usually provide the same dollar benefit regardless of your income level. Common examples include the basic personal amount and certain personal or family-related credits. This difference matters for planning. Deductions are more powerful when your income and tax rate are higher. Credits provide consistent relief but don't scale the same way. When you understand how taxes work, you gain control. You can plan income more confidently, evaluate opportunities more clearly, and make decisions that actually support your long-term goals. If you'd like help applying these concepts to real decisions, we've created a free, simple decision guide. It's designed to help you think clearly about income, structure, and timing, without tax jargon. You'll find the link below. Thanks for watching. If you found this helpful, press button below to subscribe for more clear, practical lessons on taxes, accounting, and financial lessons for small business owners.